Onto your markets news now. Asian markets ended the session mixed. Concerns remain around the potential for a trade war given the U.S. administration's tariffs posture, although talks to end the war in Ukraine are said to be helping to temper sentiment somewhat. The Nikkei share average rose by 0.3%. The Hang Seng Index declined by 0.3%, while the Shanghai Composite Index closed up 0.23%. Over in the United States, U.S. markets made a strong recovery in yesterday's session. This followed 4 consecutive sessions of losses. Consumer discretionary and tech sectors advanced, while consumer stocks were a bit more lethargic. And this is all despite the continued threat of a trade war, as well as concerns about the U.S. economy. Market players will be waiting for the latest U.S. GDP print during today's session. The Dow Jones Industrial Average declined by 0.43%. The S&P 500 ended the session up 0.9%, while the Nasdaq Composite Index closed 0.26% in the black. In terms of our local market now, we do see that the all-share index is trading in negative territory. It's down 0.5%. In terms of our currency, we see that the rand is trading at 18.43 vis-a-vis the dollar, 19.31 against the euro and 23.36 against the British pound. On the commodity front, we see that gold is trading at $2,886 an ounce, platinum at $969 an ounce, while Brent crude oil is trading at $72.42 a barrel. Well, to unpack the markets for us, I'm joined by Simphiwe Letlojane. He's an investment strategist at Absa Investments. Thanks very much for joining us, Simphiwe. So how are you seeing the local currency, especially after the release of the slightly higher CPI data yesterday? And I see that overnight the US dollar strengthened, which tends to be negative for emerging market currencies.
Yeah, I think we have seen the rand. It's still anchored quite strongly below that 18.5 USD ZAR mark. So still a little bit stable, and this is despite some of the developments, particularly last week around, that postponement of the national budget. And then, of course, in terms of the CPI print, it did edge up, but it actually edged up by less than what markets were anticipating. So coming in at 3.2%, still fairly subdued inflation. And this, of course, does support the view that we may continue to see the MPC cutting interest rates. I think what does limit the MPC from an interest rate cutting cycle perspective is, of course, what happens in terms of global developed counterparts. They do maintain that they don't necessarily follow those counterparts, but from an interest rate differential point of view, what the likes of the US and the likes of the rest of the globe does from a monetary policy perspective does influence us. And of course, with the Fed and their stance around a little bit of a hawkishness is really what has been supporting a little bit of the dollar strength that we have seen recently. But more over the more medium term, we do still anticipate that interest rates in the US will come down. Just the extent and magnitude and timing of those cuts is really what does remain a little bit cloudy.
So in the meantime, I suppose when we look at global markets, the usual sort of drivers remain, the issue around tariffs and what may be. Just give us your perspective around how that's feeding into market activity.
No, 100%. I think it's all of these factors do just make it a little bit more cloudy to assess what the global economic landscape is bound to be over the next couple of quarters. And it's really a bit of a mixed bag. Of course, on the one side, you have the prospects of tariffs by the U.S. incoming president, and of course, the threats of potential retaliation. And if that does indeed escalate into an all-out trade war, that definitely would be fairly negative, both from an inflation point of view, but also just from a company margin perspective, and that may influence company earnings and hence economic activity across board. But I think on the other side, you do, especially if you're looking at the US, do also have the prospects of deregulation, the prospects of potential tax cuts, all of these factors being a bit more positive for global markets. So a little bit mixed bag. And then I think what is also important and what we have been seeing is a little bit of a de-escalation in trade tensions, in geopolitical tensions, especially if you're looking at the ongoing talks around ending the war in the Ukraine, and then as well as the Middle East, where tensions have eased quite significantly. So it's really mixed, but there are some positive tailwinds as well as some possible headwinds around what we may see and the outlook does remain a bit uncertain.
Yeah. So let's look at one particular stock, Impala Platinum. They released their half-year results for the 6 months ended December 2024. They reported a decrease in their revenue and their profit lines. And as with so many other PGM players, their focus seems to be on extracting efficiencies in what has been a very difficult market.
Indeed. I mean, the price environment for PGMs has not been the greatest. We haven't necessarily seen platinum prices, palladium prices, rhodium prices. They've been moving sideways, and in fact, in some instances have declined as well. So they've remained fairly subdued. And this does pose quite a bit of a challenge for these miners, especially just given how high, the fixed cost base is for mining operations. And that it does make it even difficult, even though they want to focus on efficiency, it is quite a difficult, objective to be able to meet, just given how high the fixed cost of mining production and activity is. And of course, what then tends to happen is that we do tend to see a bit of layoffs, which is a bit negative for overall unemployment in the country. And it does also remain quite difficult for those miners to maintain volumes high in order to support revenue, given that they do want to cut a little bit of costs as well. So quite a lot of trade-offs that they necessarily have to balance out in terms of how they navigate this.
Yeah. And one last thing, with us obviously waiting for the proper tabling of the budget next week, what are your expectations?
Yeah, I think one of the key things we'll be looking out for in the budget is to see, the latest debt to GDP projections. And of course, one of the key highlights is around whether or not we will see indeed that 2% increase in VAT, or has government, decided on a possible different avenue. And really what we're hoping for is to continue to see government sticking to their fiscal consolidation pathway and looking to maintain debt levels, and seeing debt levels peak at current levels and potentially begin to come down, which should benefit us on many fronts, particularly around the fact that if you're looking at our budget deficit, quite a lot of it is really in deficit territory, mainly because of debt servicing costs, but primarily budget balance has actually been positive. But of course, government has highlighted that they do want to, spend money on other initiatives, and really the question mark around how they want to raise that money is what we'll be looking to see how that will be answered.
All right, Simphiwe, thank you so much for your time. As always, that was Simphiwe Letlojane. He's an investment strategist at Absa Investments. We're going to take a quick break.